Peter Lynch, One Up on Wall Street, How to Use What You Already Know to Make Money in the Market. Dive into the world of stock market investing with Peter Lynch's classic book, One Up on Wall Street. This summary unveils the secrets to making money in the market, using the knowledge and insights you already possess. Discover how being an amateur investor can be an advantage, and learn how to spot promising companies in everyday life. Equip yourself with essential investing traits and understand the 6 types of companies for a clear vision of growth expectation. Get ready to uncover the key factors that turn a stock into a winner and learn how to manage your portfolio effectively.
Amateur investors can outperform Wall Street gurus. Want to invest in stocks and achieve great returns? You don't have to be a financial expert to do it. With qualities like patience, decisiveness, and independent research capabilities, you can beat Wall Street at its own game. While professional investors are restricted by regulations, you have the freedom to invest in potential big winners. However, before you invest, remember to evaluate if you own a house, have money you can afford to lose, and possess the key traits of a successful investor. By taking these steps and ignoring gut instincts or panic feelings, you can succeed as an amateur investor. Spotting investment opportunities. Many people believe that great investment opportunities are rare, but this is not the case. According to the book, most people can identify promising investment prospects 2 to 3 times a year in their everyday lives. The key is to recognize potential growth early and take advantage of it. As a professional and consumer, you have 2 advantages in identifying these opportunities. However, before investing, you need to ensure that the predicted success will impact the company's profits. The book suggests identifying which of the 6 categories your chosen stock falls into, with fast growers being the most promising for a 10-fold increase. Understanding the various categories can help you make informed investment decisions that contribute to profitable growth. Winning the stock market. Learning how to choose the right company to invest in the stock market is the key to a profitable investment. The book explains how a stock market winner can be identified by examining its name, industry activity, and the company itself. Investing in the stock market can be a profitable experience if you know how to identify the right company to invest in. In the book, the author explains that to make a profitable investment, 3 factors need to be considered: the company's name, activity in the industry, and the company itself. The company's name may seem like a trivial detail, but it can be a useful clue when looking for a 10-bagger. Companies with simple or boring names are good prospects because they can easily go unnoticed by investment analysts, allowing investors to buy stocks before popularity pushes the value up. The same applies to companies involved in dull, unattractive, or depressing businesses. Activity in the industry is another important factor in identifying a stock market winner. Companies with few to no competitors can easily capture a big share of the market and maximize profits. Even with many players in the industry, some companies can still come to dominate the market by producing things that no one else can. The author highlights that the technology industry is particularly attractive, yet competitive. To identify a lucrative tech investment, look for a company that benefits from using the technology instead of one that manufactures it. For instance, investing in a supermarket chain that installs automatic scanners reduces its costs and increases profits. Finally, examining the company itself is another crucial aspect of identifying a stock market winner. If a company is a spin-off of a larger enterprise, it has great chances of succeeding. Parent firms only spin off companies with potential to avoid the embarrassment of launching a company that ultimately fails. Another way to spot a well-set company is by checking who's buying its shares. Buying by employees or the company itself implies that insiders have confidence in the company's future performance. In summary, the book explains that to be successful in the stock market, investors need to identify a stock market winner by considering the company's name, activity in the industry, and examining the company's background. By understanding these critical factors, investors can make profitable investments, leading to significant financial returns. Investing in earnings. When it comes to investing, the bottom line ultimately leads to a company's earnings. It is essential to examine a company's earnings, as this bet on a company's potential to generate cash is crucial. The value of a stock rises and falls with its earnings. It is vital to compare earnings with the stock price by reviewing the price-to-earnings ratio. A well-priced stock will have a price-to-earnings ratio that is equal to, or lower than the company's growth rate. Additionally, one must consider a company's future earnings, as an increase in earnings is fundamental to multiplication. Therefore, plan accordingly by assessing whether the company plans to cut expenses, expand into new territories or increase prices/sales, as each of these elements can improve a company's earnings. Investing, what to avoid. Successful investing techniques by avoiding hype and false promises. Investing in the stock market can be challenging, especially when some stocks seem too good to pass up, even if you know they're not the best investments. This is why it's essential to recognize which stocks to avoid. The most crucial rule is to avoid believing the hype. The most popular stocks can fall as fast as they grew if their value isn't supported by actual profits. Therefore, investing should be about researching potential investments rather than basing your choices on popularity. You should also avoid investing in anything labeled as the next big thing or whisper stocks. These stocks rarely live up to the expectations people have of them. The authors refer to whisper stocks as stocks in companies that make awe-inspiring claims such as curing drug addiction. The company has yet to prove itself, and investing based merely on potential is never a good idea. Another vital warning the author gave is that diversifying through acquiring other businesses may end up being a loss. In many cases, companies acquiring new businesses lose out by paying too much for the acquisition, while others do not have enough resources and industry knowledge to make their purchases profitable. The author calls such purchases diversification, as they have a high probability of leading to failure. Finally, investing in companies that depend mainly on only one customer is also not a productive investment. This is because the loss of one client results in a massive drop in the company's earnings. If a company sells 25 to 50% of its products to a single customer, it's not worth investing in. Keeping these stock market investment tips in mind will help you make more informed decisions that can lead to greater profits over the long term. Remember, investing should be about long-term strategy, evaluating the potential of the company before investing. Investing made easy. Ready to start investing but worried about the overwhelming research? Fear not. All the information you need is easily accessible if you know where to look. Your broker is a great starting point. They can help you access valuable reports and provide insights on insider buying and price-to-earnings ratios. Don't stress about reading every financial report cover to cover. A few minutes of studying a consolidated balance sheet and 10-year financial summary should give you a good idea of the company's financial health. To learn more about a company, speak to their investor relations personnel who are usually willing to provide insights. You can even attend the company's annual meetings to get a better understanding of how they operate. Lastly, remember to reevaluate your investments every few months to ensure that you're still making the right choice. With these simple steps, investing can be a breeze. Designing a high-yield investment portfolio. Investing directly in the stock market with the hope of getting a 25 to 30% return is unrealistic. The ideal annual returns for your investments are between 12 to 15%. This can be achieved by investing in mutual funds, which require less effort. Designing a good investment portfolio is essential in achieving the desired annual returns. Investing in as many promising stocks as possible increases the chances of hitting high-yielding stocks. Proper research is necessary before investing. Manage your portfolio by knowing when to buy and sell stocks. The best times to buy stocks at bargain prices are between October and December and during market crashes. Avoid selling a stock until you have enough reason to believe that the company's poor performance will not improve. Risks of options and shorts. Buying traditional stocks is a safer investment than options or shorts due to the high risk of financial loss. If you've ever considered options and shorts as an alternative to buying traditional stocks, you might want to reconsider. According to the book, the risk of financial loss in these ventures is high, to the point where you would be better off gambling in a casino or betting on racehorses. An option gives you the right to purchase a stock at a predetermined price on a certain date. However, the deadline can come before you see the desired change in stock prices. To retain your right to buy the stock, you have to continuously purchase new contracts, making it a costly venture. Shorts, on the other hand, are a bet that a stock's price will drop, not rise. You borrow stocks from an investor and sell them to someone else, buying them back at a cheaper price to pocket the difference. However, if the stock price increases, you will have to buy the stocks back at a higher price to return them to the original owner, resulting in major financial losses and debt. In conclusion, buying traditional stocks is a safer investment option compared to options and shorts. The high risk of financial loss makes them an unsuitable choice for investors.
The journey through One Up on Wall Street brings to light the world of investing and how being an amateur can be a strength. As a consumer and industry insider, you have unique insights into potential fast-growing stocks. Lynch covers 6 main categories of companies and shares the criteria for spotting stock market winners. With research, patience, and keen observation, you can create a diversified and well-managed portfolio that generates returns. Understanding and avoiding risky stocks is crucial, as is staying updated on your company's performance. So, embark on your investment journey with confidence, knowing that you hold the keys to unlocking the potential within the stock market.